My name is Cory Cuffley. I'm a manager in the Retirement Plan Services group here with SEK. Um, and today's webinar is going to be, you see on the screen, the topic is navigating 401k plans, options, updates, and compliance insights. So before we kind of jump into the agenda to see what all we're going to cover today, just as a kind of a brief introduction to myself, I've been with the firm all in for about 10 years. I was at the firm previously working in the tax and audit departments. Left for a few years to actually become a financial advisor that working exclusively in the retirement plan space. And now I rejoined SEK back in January of 2024 in our TPA practice. So really was able to get kind of a robust experience in the retirement plan industry, but kind of also, with some of my previous tax experience, it's helped to kind of be, pretty well rounded in this area. Um, so with that, let's kind of jump into the agenda here. As the name of the webinar sort of suggests, is it's pretty broad. So when we created this presentation, really what we did was we took a step back and just said, what are the conversations we're having with people on a regular basis? So from companies that are looking to start a retirement plan all the way through your more mature companies who maybe have had a plan in place for quite some time, to some that maybe are looking for other options. Maybe they have a plan and maybe you're looking to change it up and have a different plan. So as you can see, the agenda for today is, obviously want to start out, just give you kind of a high level overview of what exactly is the RPSG department of SEK and what we do. Then we're going to jump into the different types of retirement plans. Again, this will, probably be more catered towards the folks that are maybe considering starting a retirement plan or possibly, trying to decide if the plan they currently have is the right plan for them. Then I think the big piece that most are kind of interested in, and some of the questions we had gotten before the webinar were about Secure 2.0 and some of the updates there. So we're going to go through kind of a lengthy list of those, both provisions that are already in place, but also ones that are coming up rather quickly. And then we'll kind of wrap up today with some compliance insights, important dates. I mean, really throughout the presentation, we're going to talk about, compliance insights and just kind of things to keep in mind. But, we do have a couple points at the end, like I mentioned, just some things that we end up talking to a lot of people about, plan sponsors, prospects. So just, so hopefully will help just kind of make people more comfortable with the plans they have. And I should say, sorry, before we get too far down the path here, if you do have questions, please feel free to drop them into the Q&A. We'll try to monitor that throughout the presentation. My plan is to keep, most of the presentation at a very high level. Certainly if you have some more in-depth questions, we may, just take that back and get back to you on an individual basis. But, please feel free to ask questions, and hopefully at the end we'll have some time that maybe we can address some of them. Okay, so as I mentioned, I'm a part of the RPSG group, so that is an acronym. It stands for Retirement Plan Services Group of SEK. So SEK as a whole is a full-service public accounting firm, CPA firm, where we do just about anything you think of an accountant would do. But something that's kind of unique to us that not all accounting firms have is this retirement plan services wing. And really what we are is we are third-party administrators. So if you have a retirement plan, you almost assuredly have a third-party administrator associated with your plan in some capacity, even if you don't know they're there. They're in the background doing their work. But you can think of us as sort of the compliance arm of your retirement plan. So we just make sure that things are running the way they are supposed to. A lot of times you don't hear from us or most TPAs until after the close of the year. So at the beginning of the year is when we typically send out our request. Overall, we have about 14 people in our department. So we are South Central Pennsylvania based. So we have, while our offices, we have 6 offices total at SEK. We are based out of our Chambersburg office, and we do have a number of our folks that do live in South Central Pennsylvania. But just as things have progressed over the years, we do, have some remote work employees. So, even as far as, South Carolina and Wisconsin. So, but, as I said, most of ours are South Central Pennsylvania based. In total, we manage about 450 retirement plans, and that really runs the gambit. I would say most of which are 401k style plans, but we do administer 403bs, 457s, governmental money purchase pension plans, and so forth. But I guess on that note, it is worth mentioning we are an actuary, so we do not handle your defined benefit type plans. So if you're looking at cash balance, or just your traditional pension plans, we are not able to administer those. But some of our main responsibilities, things that we do, is we help design and implement plans. So creating your plan documents, setting those up, obviously reviewing if you have a current plan, you want us to take a look and see if that's if there's any adjustments you should make there. Annual compliance testing, again, every 401k plan, ERISA-based plan has to go through year-end testing. So we typically reach out at the beginning of every year, request data, and then run those tests and make sure that we pass. And if not, obviously make the appropriate corrections. Creating and filing the annual 5500 is a requirement, especially with the 401k plans. We prepare and file those, tracking legislative updates, and also preparing annual calculations. So if you're a company that's wants to do profit sharing or additional match and so forth, we help prepare those illustrations as well. One important note that I always try to mention, because sometimes it is a little confusing, because when it comes to retirement plans, there's sometimes numerous parties involved. Just to clarify, we at SEK, for your retirement plans, we actually do not hold any of the funds. So your funds that typically sit with what's called a record keeper, I have some examples there: Voya, Fidelity, Vanguard, et cetera. That is kind of where the funds typically sit and where your interaction with your plan is. So we are just strictly the compliance aspect of a retirement plan. Okay, so now let's jump into the kind of the meat of the material here today. So the first part is what I wanted to go through is just kind of talk about the retirement plan options that are available to businesses and organizations, and these can be, we'll talk about, these are all defined contribution style plans. The first few are going to be for profits, not for profits, and then obviously we have some that are tailored more towards the nonprofit and government space. But when you look at retirement plans that we typically run into on a regular basis, up on your screen is what you're going to see. So you're going to see the SEP IRA, Simple IRA, 401k, 403b, and 457 plans. So those are going to be your traditional retirement plans that you'll run into. I'm not one for reading word for word off the slide, so I'm going to try to touch on all of these, but please feel free to read through them as you're able. But I'm going to just try to give everyone kind of a high level overview of how all of these different plans work. The first actual two that you're going to see on the screen, the Simplified Employee Pension and or SEP for short, or the Savings Incentive Match Plan, or SIMPLE for short. These are IRA style products, as you'll see at the top. So effectively what they are is they're a collection of IRA accounts, but these are, business level plans that you can have. So starting out with a SEP is entirely employer funded. Okay. So if you are looking at a SEP plan, you do not have employee contributions. This is strictly the organization contributing to each of the individual IRA accounts for the participants. So some of the nuances, just again, as a high level of a SEP, they are very easy to establish. They are very low cost. But the trade-off to that is that they are not very flexible. So when you have a SEP, they are very straightforward. You don't have as much flexibility when it comes to eligibility. You don't have as much flexibility when it comes to how those employer contributions are going in. So like, for example, in a traditional SEP, if you're giving 10% of a contribution to the owner, everybody that's eligible is getting 10%. So there's no flexibility to kind of pinpoint individuals and give them different amounts. You can do up to the $70,000 maximum contribution, but again, those have to be kind of a uniform percentage to everybody. Now, we won't talk about individually designed SEPs, but there are ways that you can get a little bit of flexibility there. But the traditional SEP that you're going to find out in the marketplace is going to be kind of a uniform. And the last note there is important. It's actually relevant for both of these IRA style products, which is no vesting. So that is a big benefit to the 401k style. So meaning if you give an employee a contribution into a SEP, it's their money. So if they left the organization the very next day, they get to take it with them. But again, the SEP, very straightforward, very easy, very low cost to administer. And they're also not required year to year. So one year you can give a contribution, the very next year you don't have to. It's completely up to the organization. So if you then kind of turn to the other IRA style product, which is the simple, that is going to be closer to your 401k, 403b style, where you do have employee contributions as well. So your employees are going to be able to defer on their own if they so choose. They don't have to, but they can. And the employer, though, is going to be required to give some sort of contribution based on that, either a non-elective, which is just a contribution to everybody, or a match, which I think a lot of people are familiar with. So the employee puts in a certain percentage, the employer will match it. But again, if you're, if low cost, minimal administrative work is something you're interested in, but the employee contributions are important, the simple might be the right answer for the organization. And again, there's no vesting in a simple plan. So the money is the employees as soon as you are going to contribute it to their accounts. So moving on to the 401k plan. So it gets its own slide because that's the title of the presentation today, but those are the ones that we find most frequently out in the marketplace. So 401k plan, you see the note there. You traditionally find these in for-profit companies, but what's interesting is nonprofits can absolutely have 401k plans as well. Historically, you think of nonprofits, 403b, that's just what they're using. But 401k plans, the way the regulations and rules have changed over the years. Actually, 403bs and 401ks have become very similar. And depending on the level of flexibility you want, the 401k plan could be the right answer. So they are very flexible. So in terms of eligibility, what you want your company contribution to be, you have a lot of flexibility in the design when it comes to a 401k plan. But when you compare those to the simples and the SEPs that we talked about previously, there is a lot more involved. So there's a lot more administrative requirements, more higher cost. Part of what you want to be sure of is, do you have the infrastructure to manage these? But you do have higher contribution limits compared to the simples and the SEPs. One of the things we'll talk about some of these catch-ups and contribution amounts later on. But the employees do have a lot of savings capacity in a 401k. You also, within the 401k, you do have the ability to do discretionary employer contributions. So it's not just, hey, I'm giving a match and the employees are saving money. The organizations can choose to do something above and beyond, but that's where all that testing typically comes into play. And that's what we do on our side, is we make sure that those tests pass and that those contributions are appropriate. I do have a note here on safe harbor versus non-safe harbor, because I do think or those terms typically kind of either get lost or confused when folks are looking at their plans. A 401k plan can either be a safe harbor plan or a non-safe harbor plan. And really in kind of a big picture, what that means is, there's a number of tests. I keep mentioning the year-end compliance testing. There's a number of tests that these plans go through on an annual basis, the 401k plans. If you are a non-safe harbor plan, you have to go through those tests. So there's a number of, an ADP, an ACP, and so forth, that we have to look at and make sure that the retirement plan stays compliant. And there's limits on how much people can save under a non-safe harbor plan. What some organizations will do is they'll elect to be a safe harbor plan. And what that effectively does is it really just buys you out of certain tests. So then we don't have to necessarily worry about, say, the ADP test. So that gives the higher earners, the owners, the ability to save whatever they want, and they don't really have to worry about what the participants are saving. So, I don't want to go too far in depth there, but just know, the 401k plan, that's the plan, and then that plan can either be safe harbor or non-safe harbor, and there's reasons for, maybe being one versus the other. But vesting is a big benefit when it comes to 401k plans. So, vesting, when you give somebody participant money in a 401k plan, and they leave your organization, they can actually only take their vested balance with them. So typically what organizations will do is they attach vesting schedules to, say their matching contribution or their profit sharing contributions, so that it kind of ties that individual into the organization over the number of years. So, it kind of, you know, hopefully makes them stick around longer, and help to retain that talent a little bit. But that's a major benefit for the 401k style plan. And then the last two I'll touch on, 403b plans. Again, they are becoming increasingly similar to the 401k plans. They are found in nonprofits and some government entities, and actually churches as well can have 403b plans. An interesting note on 403b plans that to keep in mind is ERISA is kind of the overarching legislation that plans are beholden to. So the ERISA is kind of dictates kind of the minimum standards that plans have to follow, a lot of the notification requirements and so forth. What eligibility can be and so forth is dictated by ERISA. 401k plans certainly follow ERISA. 403b plans, though, depending on how they're set up, they can either be ERISA or non-ERISA style plans. And I won't go too much further into it there, but just be aware that 403b plans can be one versus the other. But in general, they are very similar. You do have employee contributions, you have employer organization contributions, and you can actually do discretionary contributions as well into a 403b. And just like the 401k, the employee contributions can be either pre-tax or Roth. One of the unique features, I'll say two unique features of the 403b plan when you kind of compare and contrast them to the 401k is 403bs have this idea of universal availability. So if you have a 403b, the basic rules state that if one person's eligible for the plan in the organization, everybody should be eligible for the plan to contribute to the plan. That is a difference to the 401k. There are exclusions that are available in the 403b, for example, people who work less than 20 hours a week, but overall pretty similar. One of the differences you will find is the investment choices in a 403b are a little bit more limited compared to a 401k. But even that, there's legislation out there to try to get those a little bit more similar as well. And the other unique feature of a 403b, so if you're one of those organizations, a nonprofit that's thinking about 401k versus 403b, in the 403b, there is no ADP test. So that is the test that looks at deferrals. So if you are a nonprofit organization that has a lot of highly compensated employees, a lot of times the 403b could make more sense because you actually don't have that test at all. So that whole idea of safe harbor versus non-safe harbor, may not be as big of a concern in that situation. So, but overall, pretty similar. And then the last plan, the 457, that is a plan typically found in your government entities. They are, at least for the plans that we administer, we try to have those as deferral only, but you can have employer contributions in those as well. But typically, when it comes to government entities, you have your 457 is a where the employees save their money, and then you'll have a money purchase pension plan that covers the employer contributions. So, but those, when you see 457s, those are typically what you find within the government space. And then last thing, just to kind of wrap up the section, now that we've kind of just talked broadly about the different plans that are available. So some of the things that you want to think about when you're trying to decide what plan makes sense. How much money are you trying to get into the plan? Are you trying to get significant deductions, or is it just kind of a savings vehicle? So the amount of the deductions aren't as important. So obviously the 401k is going to offer you the most savings capacity amongst those plans. Amount of flexibility. One of the benefits to the SEPs and the simples is they are very easy to administer, but you lose a lot of flexibility. So you don't have as much creativity when it comes to, when do people become eligible to get into my plan, and also what can I give them as an employer contribution. The 401k style plan is going to be a lot more flexible in that instance. Administrative burden and staff. So certainly the 401k, 403bs, there's more involved, making sure, just all of the rules are followed within the plan document. Notices are distributed and so forth. So they're a lot more involved. SEPs and simples require almost no administration. Honestly, once you set those style plans up, they just kind of run. Cost sensitivity, simples and SEPs, very low cost. 403Bs tend to be a lot more expensive. So that's certainly something to keep in mind. And then our employee contribution is important. So what exactly is the goal of your retirement plan? Certainly, if you want employees to contribute, you're going to want the 401k, 403Bs, but even simples. Simples have an employee component as well. But what you won't, what you don't want in that instance would be a SEP because there's no employee contributions involved. So just a couple things to think about as you're navigating what plan makes sense. Certainly, you can always reach out to me. I'm happy to have that conversation with you as well if you're in that if you're at that point where you're looking at what plan makes sense for your organization. Okay. So now I think we're on to the part that most are interested in hearing about. So I have quite a few slides here on Secure Act. Some of the questions we've received specifically relate to the provisions that are taking effect really both here in 2025, but also in 2026. But I did think it was relevant just to kind of go through more of Secure Act. So quite a few of these slides are going to include provisions that have been in effect for a few years now. But just as a overall reminder of kind of the full scope of the Secure Act and things just to keep in mind, because we haven't even done the Secure Act amendments yet. So some of these things are just kind of knowing what your plan decided to do. So with the Secure Act, I didn't include the detail here, but just keep in mind if you have started a plan, within the last couple of years, or you're planning to start a plan, just keep in mind that there were good increases to the retirement plan credits. So if you're starting up a plan, or like I said, you're within the first few years of a plan, just know that you do have a startup credit available to the organization. There's actually 4 parts to the retirement plan credits, and I have them on the screen here. I don't include the detail. We do have a nice piece on our website, though, if you want more of the information of the credits specifically. But the 4 pieces of the credits are, the startup credit, so costs associated with starting a plan. That also includes, education. So if you want to include a financial advisor that's, educating your participants, that does include those costs. There's an employer contribution credit, so you can actually take some of the money that the employer is contributing to the participants and turn it into a credit as opposed to a deduction. Automatic enrollment. So if your plan includes automatic enrollment, you get a $500 tax credit for the organization as well. And the military spouses credit. So this one's a little bit more, I'll say, complex and a lot less common, but that is a credit. So if you're an organization that employs a lot of military spouses, you may have that available to you as well. And like I said, it's a little bit involved and it's a calculation, but certainly if that's something that you think about and yes, hey, we do a lot of, we employ a lot of military spouses, certainly reach out to us. We can help you with that calculation if need be. But those are the 4 pieces. So again, that's just kind of a public service announcement. Just keep those in mind for the organization. Mandatory force outs for small balances. This was something, was always something you could do in a retirement plan, but it actually was increased with Secure 2.0. You'll see some of these provisions, I have optional listed beside the title. Some are mandatory, but some are optional. But I would say most that are utilizing the mandatory force out level did increase this. So it jumped from $5,000 to $7,000. So what that means is if you have people that leave your company and they have less than those amounts, again, it was 5,000, now jumped to 7,000, you can actually force them out of the plan. So you can force them either to take their money entirely if it's a small enough balance, or you can roll it, have the record keeper roll it out to an IRA. So you just get it out of the plan. And that'll become important later on when we talk about the plan audit requirements. But that's just something to keep in mind, knowing where your plan stands. Does it do the 5,000? Is it 7,000? And is it being done on an annual basis? Because it's something you want to, it's in the plan document. You want to make sure you're following those rules and you're actually following through with that on a yearly basis. The R&D age that was increased. That's been increased a few times now. Originally, it was 70 and a half, jumped to 72, but it did jump to age 73 now after December 31st, 2022. So anybody who is, in your plan that is past, 73 or older, if they are no longer employed, okay, they have to take a minimum amount out of their plan each year as a required minimum distribution. An interesting thing to keep in mind, if you have someone in your plan and they are age 73 or older, but they continue to work, you can actually delay that RMD requirement until you retire and fully separate from employment. And there's no real, hours requirement there. A lot of people go part-time later on. It's really just if they maintain active employment, they can defer that RMD. But, just as an interesting note, your first RMD is, due by April 1st of the following year, whenever you hit that RMD requirement. But if you do delay it, you may have two in the first year because it's an annual requirement after that. So it's by December 31st. So just keep that in mind. Normally your TPAs, I know that that's something we monitor pretty heavily and make sure that we get that information out to the people that's required. I should say that the exception to delaying your RMD is if you are more than a 5% owner. So if you are more than a 5% owner and you are past the RMD age, you do have to take RMD. So you don't get to delay that because you're currently, actively still employed. So that is one exception to that rule. But for everybody else, you can delay it until you separate from employment. Long-term part-time employees. So this is something that 401ks would have, kind of been working with actually starting in 2024. I do have a note here. 2025 is going to be the first experience 403B plans have with it. But this whole idea comes from, the government just trying to make these plans more accessible. I talked a lot about the flexibility when you determine eligibility for your plans. A lot of times we'll find plans that say, hey, you have to work a year with us and work 1,000 hours, or maybe they just exclude part-time employees altogether. And I think what the government recognizes, they still want people to be able to save. So even though you maybe are keeping them out of your plan based on that year of service, this actually can get them in sooner and actually get them in. Maybe they wouldn't have been in ever, from that standpoint. But effectively, what the long-term part-time rules say is if you have someone that works, now the rule is 2 consecutive years of 500 hours or more, you have to let them into your plan, but just to defer. So it doesn't mean you have to give them a company contribution, but you have to give them the ability to save into your plan. And the original Secure Act actually had that at 3 years, but with Secure 2.0, it got bumped to 2 years. And a couple things to keep in mind is, it is consecutive. So if you had someone that hit 500 hours, the next year they hit 4 something, and then they hit 500 the following year, that does not count. It has to be consecutive years. And then once obviously they're in, they're able to defer going forward. So again, that's something to keep in mind. But there was a difference in timing between the 401k and the 403bs. That's why 403bs, you could ignore service prior to 2023. So that's why 2025 became the first year that you would see potentially long-term part-time employees joining your plans. But the 401ks 2024, I believe, would have been the first potential year. But something to keep in mind, something to monitor. Hopefully you're getting that information from your TPAs. I know we monitor it here and let our plans know that they have potentially to long-term part-time employees that are jumping in, but you want to make sure they get that opportunity to save. The failure to take RMDs. So, we were talking about that jumping to age 73. There is a penalty for folks that don't take that. It's a penalty that the individual pays. That used to be 50%. So it was pretty, steep penalty if you didn't take it. So whatever that RMD was, 50% of it was the penalty. That actually has been reduced to 25%. We did get a question that was submitted in advance about some possible charitable distributions from plans or charitable giving options. And I did include this qualified charitable distribution, or QCD for short. This is actually one of the few things in here that's not really retirement plan based, but I did think it was relevant, again, because we were getting some questions and it is Secure 2.0 related. But if you have someone who is inclined to give to charity, and especially, pretty significant amounts to charity, there is this charitable qualified charitable distribution QCD that is possible. Now, it can't come from the retirement plan though, so it is something. If you had someone that is looking to do this, they do have to move it out of the retirement plan and into an IRA. But effectively, what it does is it allows you to contribute to a charitable organization directly from an IRA. And what it does is that distribution from that IRA would be tax free. So you would not owe tax on that money up to a certain amount. And you can see on the screen, individuals, I should have mentioned that at the beginning. So it is for individuals that are 70 and a half, which was the original RMD age, but that is for QCDs the way it stands. So you have to be at least 70 and a half years old, but you can donate at right now, it's up to $108,000. So $108,000 can go directly to a charitable organization from an IRA on an annual basis. And that's indexed for inflation. So that grows as well. Two bullet points there, interesting notes. It cannot be to a donor advised fund, a private foundation, or supporting organization. Otherwise, if it's just a charity, it can absolutely go. It does have to go directly from the IRA. So you can't take it out personally and then turn around and give it to them. It actually has to go directly from the IRA to the organization. I found a lot of times IRAs will have, you can get checkbooks, for certain IRAs that you can actually just write the check directly to them, or have it set up just to go into the charity. But it does also satisfy the RMD. So sometimes you run into people who, they have to take RMDs. They don't really need to take RMDs. Maybe they have enough, or Social Security is covering what they need, but they still have the RMD requirement. You can use the QCD to satisfy an RMD, and then that way the distribution isn't taxable. So just something to keep in mind. Self-certification of hardship withdrawals. If your plan allows for hardships, historically, you have had to, or it's been the kind of the plan sponsor's responsibility to have support for it. So, a hardship is one of the ways that a person can get into their balance, before they retire or turn a certain age, or separate from employment. So a hardship is, there's a number of different categories, medical expenses, you're about to be evicted from your house, and a few others. But there was always a requirement to obtain some sort of documentation. So you couldn't just, in the past, have a participant say, I have a hardship, and you give it to them. There had to be some sort of documentation, an eviction notice, medical bill, and so forth. What Secure 2.0 allowed for is, if the plan sponsor chooses, they can rely on self-certification. So effectively, you can now take the participant saying, hey, yes, we have a hardship need, and you can kind of have them sign off and say, we agree that it absolutely is a hardship. So that is an optional provision. I do see some plan sponsors taking it, others not, but it is being more and more adopted. So just something to keep in mind, if you haven't had that conversation, if you're a plan administrator, plan sponsor, just maybe take a look, see if that's something that your record keeper, a lot of the record keepers are actually allowing for self-certification directly on the website. So a participant can go on and actually request the distribution, and they can check a box saying, yep, we agree that we meet these requirements. But either way, just be aware of what your plan has decided to do, and have just some sort of documentation saying, yes, we're doing self-certification, or no, we're going to stick to the old model of we need support for that type of distribution. Pension-linked emergency savings accounts, or PLESAs. So this is a new option that's available. To be honest, we haven't had anyone. We've had questions, but we haven't had anyone actually follow through with adding this provision. But this is a way, if you're interested, your plan can offer the ability for your participants to save. It's effectively a savings account within the 401k. It's a separate account, but kind of under the same umbrella. But it allows them to save up to $2,500 per year, and they can access it. So it's very much so like a savings account. It's an optional provision. But we haven't seen it widely adopted, but just be aware that it's there. RMD rules for Roth, an interesting component of those required minimum distributions is, as most people are aware, a Roth IRA that you may have on your own did not and does not have an RMD requirement. So you don't have to take RMDs from your Roth accounts. But before Secure 2.0, when you had a 401k plan, even if it was Roth money in the 401k, that actually did factor into your RMDs, and you had to factor that balance into the total balance to figure out what you had to take out. Um, but and it did cause confusion because people are familiar with Roth IRAs and their lack of RMD rules. So this actually eliminated that. So you no longer have to worry about your Roth balances and employer plans. Simple to 401k. So historically, you if you had a simple IRA plan and you wanted to move to a 401k, you can only do that at the beginning of every year. That actually has gone away. So now you can make a switch mid-year to from a simple to a 401k, as long as that 401k is a safe harbor plan. And there's certain rules and limits when it comes to that, but just know that that's a possibility. Qualified student loan matching. This was something that years ago, a company out in the Midwest actually got a private letter ruling because they thought this was a great idea. But at the time, it was only they were allowed to do it. And since, people got very interested in the idea, and now with Secure 2.0, it's kind of opened it up to everybody. But it's this idea that, you have uh, uh, participants, employees that probably have a lot of student loans. They're just coming out of college, so they don't have the ability to save in your retirement plan. And if that's the case, and your company offers a matching contribution, well, they're not able to get the match because they're just not saving into the plan. So the idea behind the student loan matching is you can take their contributions, or I'm sorry, their payments they're making to their student loans and effectively treat them as contributions. And what that allows the employer to do then is to put matching contributions in, even though the employee technically isn't saving into the plan itself. Again, I think this is a provision that's talked about a lot, but we haven't had anyone, follow through with implementing it. But just be aware, if you're an organization that has a lot of people that, maybe aren't saving, and people are kind of strapped with student loans, it is an option. There's a lot of different ways to do it because one of the pieces to it administratively is you have to verify that they're making those student loan payments. So there are services that have been put out, and they're evolving as well, but that can actually link into their student loans and verify that for you. But certainly if that's something of interest, we can have that conversation. Employer contributions in Roth. So historically, employees typically have been able to save their own money either as a pre-tax contribution or a Roth contribution. One of the things that Secure 2.0 has allowed for is it allows employees to say, no, I also want my employer money. So the money I'm getting from my organization, I want that to go in as Roth as well. Now, this is one that, excuse me, we do have employers are looking to do more of. But we certainly want to be cautious of it if you do choose it. And the reason is because the mechanics of it, the way we understand it, is that if that's a choice an employee makes, they say, yep, give me my employer match, but I want that to be Roth. I don't want it to be pre-tax. What will likely happen is at the end of the year, that employee is going to get a 1099 because effectively it's a treated more like a Roth, in-plan Roth conversion. You're converting a pre-tax money, because the employer is getting a deduction for it. You're converting it to Roth. So what is likely to happen is your participants are going to get a 1099 at the end of the year that they'll have to file on their taxes, and it could be a little bit of a tax impact that they're not prepared for. So just be a little cautious with that one. But it is an option. Certainly there's savvy people out there that know exactly how that works. But I think one of the things as a plan sponsor that you want to be aware of is people may hear all Roth sounds good. I want all my money in Roth, but they may not be thinking through the whole process. And you certainly don't want anyone to get a tax impact that they're not prepared for. But that is an optional provision that an employer can do. Emergency expense withdrawal. This is just an additional withdrawal option that a plan can put in place. It allows people if they're really in a pinch, they can get a certain level $1,000, out of their account to help them meet, a certain emergency. And it is an exception to the 10% early withdrawal penalty, and self-certification is a part of that. So just be aware that's something that you have available to you as a plan sponsor. If it's something you're getting a lot of people reaching out, hey, I really need to get into my balance for, X reason, maybe it's a viable option. A couple other uh, early withdrawal options. Again, these are designed to allow people into their accounts, maybe before retirement age or before they're, eligible for a distribution. Terminal illness, and sorry, I should say all three that you see on your screen are optional. So a plan certainly does not have to allow for any of these. But terminal illness, so if you have somebody that has a terminal illness, it's a little morbid, but there actually is a physician certification you need to get for that. Suggesting that there's death imminent in the next 84 months, but that will allow them penalty-free withdrawals from their account in advance. Qualified birth or adoption distributions, you can allow people to distribute up to $5,000 from a retirement account within a year of the birth or adoption, and that's a penalty-free withdrawal as well. And the domestic abuse withdrawals, along the same lines, it allows for an early distribution from an account if your employee participant is the subject of domestic abuse. So all optional. So, have conversations with, all of these provisions with your TPA and see if it's something you are interested in allowing for. Okay, so now the more recent things. So both of what you see on the screen here are actually 2025 provisions. So these all took effect officially this year. So the automatic enrollment mandate, this was something we've been talking about for years because it's actually for plans. Any plan that started after December 29th, 2022 was required to include automatic enrollment in their plan. But they had a few years to implement it. So even though 2022 was several years ago, it didn't actually take effect until 2025. So as of this year, all of those plans and all plans going forward need to include automatic enrollment. And I don't have it on the screen, but it needs to be a minimum of 3%. But if it's less than 10, it has to escalate to 10. So I know for us, most of the plans that we just start automatic enrollment at 10%. Employees, when it comes to automatic enrollment, employees are able to opt out. They're able to pick a different percentage. But at least if we go to 10, we don't have to worry about every year automatically increasing participants until we get to that 10 level. So just something to keep in mind. But if there are 4 main exceptions to the automatic enrollment mandate. So if your plan started before that date, obviously you don't have that mandate in place. So you do not have to have automatic enrollment. Church and government plans also are not required to have automatic enrollment. If the business itself has been in existence for less than 3 years, again, another exception. So obviously, once you hit that threshold, it changes. And employers with 10 or fewer employees, so your small employers actually are not required to have automatic enrollment either. But there is a 1-year grace period. So if you're a small employer and then you grow past that limit, you do have a year then to implement that automatic enrollment provision. The other big one, or maybe probably the bigger one that impacts more plans for 2025 is going to be this increased catch up for ages 60 to 63. So I do have it as optional, although most of our plans are allowing for catch up contributions. So from our standpoint, we allow it for our plans, but it is something to just be aware of. Maybe confirm again if you're a plan sponsor, just confirm if that's something your plan is doing. But what this provision does is it's important to know this isn't a separate catch up. Okay. So there has always been a catch up in place. Individuals are allowed to save their own money up until age 50 at a certain level. Once they reached age 50 or older, they had this catch up available to them. And it's always been, or it's been for quite a while, $7,500. So you have the under 50 deferral amount. And then if you're over 50, you can save an additional $7,500. So what this increased catch-up does is it just takes that $7,500 and it increases it, but only for people who are 60 to 63 years old. And you can see the formula on the screen. It's that increased catch-up is the greater of $10,000 or 50% more than the regular catch-up. So for 2025, that's $11,250. So again, if you have individuals in your organization, and this is a provision that you allow for, if they are 60 to 63 years old in 2025, they can save the deferral amount, the under 50 amount, plus this catch up of $11,250. So I believe that brings, we're going to talk about limits later, but it's going to be $34,750. So is the max that someone in this age range can do. But an important thing to know is if it is a year in which they turn 64, they do not get it for that year. So it is strictly for people who are turned 60 and are in that 60 to 63 band. But the year you turn 64, you're not eligible for that catch up. So if you have any questions on that, please feel free to ask. But that is specifically for those ages. And I will say, I know for our payroll systems, it's actually something that I've noted that you actually have to check in some instances. So do check with your payroll companies if you're doing payroll internally or even externally. Just check how they're handling that. Make sure that their system is activated to that. I think most probably are, but again, it's just something to look at. Not I wouldn't say a significant number of people are getting to that max level, but there are people out there that are trying to. So just keep that in mind and make sure that you're looking for those. And then the big one, the one that everyone's excited for, which starts January 1 of 2026, and it is mandatory. So it is the catch-up contributions in Roth. So what this is saying is starting next year, if you have someone that is making a catch-up contribution, so they are maxing their under 50 deferrals and now they're into the catch-up contribution portion, if they made over a certain dollar amount in the prior year, those catch-up contributions have to be Roth contributions. So a lot of times you're looking at individuals that are in that range that are making either maxing their deferrals, maxing their catch-up contributions as doing all pre-tax. They can still do their ordinary deferrals as pre-tax, because that's a tax-saving mechanism for them. But what this is saying is once they get past the under 50 limit and they're into the catch-up range, those catch-up contributions have to be Roth contributions. The dollar threshold for that is $145,000 in FICA wages in the prior year. So again, this is starting at the beginning of 2026. So 2025 is going to be the prior year. So anybody in 2025 who makes more than equals or exceeds $145,000 in FICA wages, starting in 2026, those individuals, if they're making catch-up contributions, those catch-up contributions have to be Roth. So I think it's very clearly a tax revenue generator for the government. They're looking to get more tax revenue now as opposed to down the line. So that's one of the reasons. One important thing to note is that the $145,000 doesn't really match anything else. So it is not the highly compensated employee limit. Okay, so that is a different amount. And it's not the Social Security taxable wage base. So it is a different amount altogether. So just don't get those two things confused. But that $145,000 will be indexed for inflation going forward. But it's something to be aware of, especially if you do have people that are making those catch-up contributions. So what plans need to look at and make sure of leading up to next year is, number one, does your plan allow for Roth contributions? Most do nowadays, but not all of them. So just make sure that your plan allows for Roth contributions. And also, is your plan allowing for catch-up contributions? Because if your plan allows for catch-up contributions, but you're not allowing for Roth, you may have an issue. And those individuals that maybe want to do catch-up contributions really won't be allowed to, because you have to do them in Roth and your plan doesn't allow for Roth. So it is something to monitor. I'd highly encourage you to take a look and see, what does your plan allow for? Are you allowing Roth? Do you allow catch-ups? But then also check with your payroll companies. Like, are your payroll companies ready? Because I know that's a question. So, how is this stuff going to be monitored? Is it going to be something that, people are ready for? There's almost assuredly going to be issues. So we haven't seen a lot about corrections yet and how to approach that. this was actually something that was supposed to go into effect in 24, but people, really were up in arms about it, about how to get those in place in time. So it actually was delayed until 2026. I think most people are hoping it's going to get delayed again, but as of right now, we have to go forward with the idea that it's coming. So, but it does apply to 401ks, 403bs, and 457s. So just be aware. But certainly inquire of your payroll provider, inquire of your record keeper to see if they're ready. I've asked a couple already, and they couldn't really give me a good answer. So it sounds like, at least for now, a lot of them are still in development, making sure that those are ready. But that's the one most are hoping goes away, and that's effectively how that one is gonna work. But again, if you have any questions on that, please let me know. But that does start January 1 of 2026. And then the last one with the Secure Act, this was a few years out, so I always hesitate when to put things in here this far out. But just be aware, coming down the line, the RMD age does get increased. So in 2033, that's going to jump to 75 years old. So the last section here, as we wrap up, I just want to talk a little bit about some compliance insights and important dates. A lot of this, we kind of had compliance comments throughout the presentation. Really, these are just some other things to keep in mind. So if you're a plan sponsor or plan administrator who's working with your plan closely, or you're looking to start a plan, just keep these things in mind. Again, they come from conversations that we have with plan sponsors quite often. But just be aware, if you're doing a matching contribution, think about, is that a per pay period match, or is it an annual true up match? And what I mean by that is, yeah, you may be contributing your match on a per pay period, but within your plan document itself, it's going to say, is it calculated on a per pay period basis, or is it an annual true up? And the difference is, if you're calculating on a per pay period basis, if you have somebody that maxes out early in the year, they're not going to get matched for the rest of the year. And so when you look at their whole year's worth of compensation and contributions, they may actually not get the full match for the year because it's on a per pay period basis. But some plans are set up as annual true up. And what an annual true up would do is, it would, the TPAs like myself would look at the year and say, hey, this individual really only got 3%. They should have gotten 4. You owe them an additional percentage. So just something to keep in mind and maybe focus it on, and just be aware of if you're monitoring your plans. Coverage is something that, especially if you're a plan, that has a lot of exclusions. So you exclude, the shipping department, or this group of employees. Coverage is still something you have to watch out for. The way these plans work is, you typically have to cover, and when I say these plans, typically the 401k style plan, you have to cover at least 70% when you look at your highly comps to your non highly comped employees. So your coverage ratio needs to be 70%. So just be aware of that. If you're looking at these plans and you have a lot of exclusions, or you're looking to add exclusions to your plan, you still need to cover 70%. And if you don't, you typically have to amend your plan to allow more people in to participate. From an audit perspective, audits, the way 401k audits have changed over the years, it's actually changed from eligible participants to account balances. So now, if you're a plan that has never had an audit, you're just kind of, cruising along, but you're growing, that initial audit gets triggered at 120 balances. So if you have more than 120 balances at the beginning of the year, that's what triggers the initial audit. But the ongoing requirement for an audit is 100. So as long as you maintain 100 balances at the beginning of the year, you're going to have an ongoing audit requirement. So, but that's where some of those force outs come really handy, because I've seen plans with lots of small balances that really could be forced out, and you just want to keep an eye on that on an annual basis, because if you're getting close to that audit requirement, getting some of those people out of the plan can help. This is a big one, and this is another public service announcement, but just be aware of something called affiliated service or control groups. So if the ownership of your company also owns other businesses and individuals, so if the individuals own your business, also own other businesses, especially with employees, there could be some combined testing that's required. And you just have to be aware of that. So what I would say is, if those are the situations, just make sure your TPA is aware, so that they can do their analysis and make sure, because that can be something that trips up a lot of plans when they have multiple controlled entities that really do need that combined testing. The affiliated service group is along the same lines, except it's less about ownership and more about shared services. So if you have two organizations and really they're just giving service back to one another, and that's the way they operate, you could be in this affiliated service group classification. And it's similar to the control group. There could be some combined testing that needs to take place and similar benefits need to be offered and so forth. So again, just keep those in mind. Real quick, just at a high level, plan documents. There's a lot of different plan documents. A lot of times when we request things from people or people send us stuff, some of the terms just get mixed up. Every plan has a basic plan document. Basic plan document is everything in your plan, how your entire plan operates. But the adoption agreement is actually the document that's going to give you the specific provision. So if you're looking for the document that actually says, okay, what is our eligibility? What is our vesting schedule? That is going to be in your adoption agreement because that's where you get to make those selections. So just a kind of an informational piece there. And then your summary plan description is more of the, I say, plain English of the adoption agreement. So the summary plan description is supposed to give your employees the plain English, this is how the plan works according to the adoption agreement. So a lot of it's mirrored, but it's more of commentary in the summary plan description, whereas the adoption agreement is actually the selections themselves. So again, just wanted to clarify some of those pieces for everybody. All of the Secure Act stuff we talked about, so a lot of stuff was optional, but some of them was mandatory. Your actual amendment to choose what you are doing is not due until the end of 2026. So that's obviously a little ways away. So in the interim, we just tell people, just maintain some sort of documentation, just some notes like, hey, this is how we are handling our plan, and just be aware of what you're actually doing. So what is actually set up at your record keeper, because you don't want your participants going online to do something that your plan document is actually not allowing for. But those amendments are not due until the end of 2026. And coming up, we have what's called the Cycle 4 restatement. So every 6 years, a retirement plan is required to restate their documents in their entirety. And the reason is because they want, plans to kind of roll up all of these amendments into the main documents. You don't have all these extra pieces floating around. So that starts in October of 2026. You'll hear from your TPAs. I know all of our clients will, where we need to start to restate those documents. But an important thing when you look at these dates, the cycle 4s are going to have some elements of Secure 2.0. So some of the things that would go into that secure amendment are actually going to be in the document itself, but not all of them. So everyone is still going to have a Secure 2.0 amendment, but depending on when you do your restatement, that amendment is either going to be bigger or smaller. So certainly if you are going to do your restatement before December of 26, your actual amendment is smaller because most of that is going to be in the restatement. But if you do it, in 27 or 28, your actual secure amendment is going to be a little larger. So again, just kind of a heads up on that those are coming. From a date perspective, just a couple, things here as we kind of cruise to the end of the year. September 15th, that's the extended due date for S Corps and partnerships. So if you've extended those returns and you're making contributions that you want deducted, that's the due date for those. October 1st is the deadline to establish. So if you do not have a plan at all and you're looking to set up a brand new plan for 2025 and want it to be safe harbor, that is the deadline for that. Or you have a plan that's not safe harbor and you want to add a safe harbor match, that is the deadline for those. October 15th, that's the extended due date for the 5,500. So we'll be, any of our plans on extension, that's where we're aiming to have those complete by. And it's also the deadline for C Corps and individuals. Last date here, December 1st is going to be your deadline for distributing notices. So if you have a safe harbor match plan, those need to go out by December 1st. Same with an automatic contribution arrangement. If your plan includes automatic enrollment, that is the due date to distribute those notices for 26. And the QDIA notice, which is typically an investment. It's usually the record keeper based notice and refers to the investments in the plan. And last slide, just give you a high level of the limits for 2025. So the deferral limit, so that under 50 limit is $23,500. And I should say we don't have the 2026 limits and won't until closer to the end of the year. The simple is 16.5. That catch up for the 401k is still at $7,500. The catch up for the simple is $3,500. But again, keep in mind that 60 to 63 catch up if you have individuals in that range. The 415 limit for defined contribution plans, so 70,000. That's just the max any one person can get into their plan in a given year. And the most compensation we take into account. So if you have somebody that makes $1 million, it doesn't matter for plan purposes. We can only take into account up to 350,000. And then just one more, the uh, highly compensated employee definition. So whether someone's in that category of employee is 160,000 for 2025. And all of these limits are on our website as well under the resources tab.